Welcome to Thought Leadership Thursdays with Cashbox Global. I'm Gill and I take care of the investor community. It's great to have you with us today as we dive into another session designed to help you make smarter, more confident investment decisions. If you're joining us for the first time, Thought Leadership Thursdays are monthly sessions or articles exploring relevant topics that investors should know about. But first, some housekeeping. Our session today is to introduce the glider feature and explain how it works. It's intended to be educational and doesn't constitute personal investment advice. Structured notes are not risk-free, and outcomes depend on the terms of each contract and how the markets behave. This is why education is paramount. Always make decisions based on your own research and professional advice where needed. With that, let's get started. Structured notes didn't suddenly change overnight. Over time, as markets changed, new features were developed to deal with how the markets actually behave. After the global financial crisis and later events like the Eurozone crisis, COVID, and inflation shocks, markets became more unpredictable. We still saw opportunities, but they were less smooth and less consistent. Traditional growth notes often relied on one key level being reached for returns to be paid. If markets didn't recover cleanly or quickly enough, those opportunities could be missed, even if markets weren't doing badly. At the same time, investors were asking for income, more efficient use of capital, and structures that could still work even when the markets weren't ideal. This led to new ways of designing structured notes, with more emphasis on early protection and flexibility, without giving up the longer-term return potential. Glider notes came out of this thinking. Instead of fixing everything at the start and hoping markets behave perfectly, the structure can adjust based on what actually happens in the early part of the investment. At its core, a glider introduces time into the equation. Rather than having only one fixed opportunity for the note to end early, the structure can create an additional opportunity later on, depending on how the markets have behaved. The reality is, markets don't move in straight lines. Glider features are designed with that reality in mind. They work with volatility rather than assuming perfect recoveries. We're now going to move on to how the glider feature works. So the job of the glider feature is to increase the probability of an autocall at a specific point in time. I'll start with a quick reminder of how a standard growth note behaves. Then we'll layer in the glider feature and walk through a few scenarios so you can see exactly how outcomes change. You'll remember that in a standard growth note, we have the quarterly observation dates. In this example, the autocall feature goes live at the second quarter, which is at 6 months, and the autocall trigger level is set at 95%, which carries through from the second quarter until maturity. If on any observation date, all underlyings are at or above the autocall trigger, the note autocalls, maturing early and pays back your initial capital plus the coupons for each quarter that is passed. If the note doesn't autocall, then a final observation at the end of the term, the capital protection feature applies. If all underlyings are above the capital protection barrier, full capital is returned. If not, capital is reduced based on the lowest performer. Now let's look at the inclusion of the glider feature. Like the example in the previous slide, the regular autocall feature goes live from the second quarter. But unlike a standard growth note, the underlyings are now observed daily between the strike date and the glider observation date. What it's checking is very specific. It's checking that all the underlyings have remained at or above 60% of the start price. You can think of it as the glider barrier. As long as none of the underlyings have touched this glider barrier, the glider feature then activates. If the underlyings have remained above the glider barrier level, then, at the glider observation date, the autocall trigger drops from 95% to 60% for that observation and the opportunity for an autocall. Here, the glider observation is at the fourth quarter, being set at 12 months. If underlyings have dropped below the glider barrier, then the auto call trigger is going to revert back to its original level of 95% for the rest of the term. The capital protection barrier feature remains unchanged and is only assessed at the final observation if the note has not already auto-called. In this first scenario, markets have behaved well. On one of the early observation dates, all underlyings are at or above the 95% auto-call trigger. The note auto-calls in the normal way, paying the initial capital plus coupons accrued. In this case, the glider feature never comes into play because the investment ends early. In this second scenario, the note doesn't auto-call in the early quarters. During the 12-month daily observation period, none of the underlyings ever fall below 60% of their start value. As a result, the glider condition is met. The auto-call trigger barrier steps down from 95 to 60%, and the underlyings being above the glider auto-call, the note matures early, and accumulated coupons are paid together with full capital, and the contract ends. Here, one of the underlyings breach the glider barrier before month 12. When that happens, the glider feature is cancelled entirely. The note then continues exactly like a standard growth note, with the auto-call trigger remaining at 95% for the rest of the investment term. If the underlyings breach the regular auto-call trigger, capital and coupons are paid out as normal. If the note never auto-calls, whether or not the glider was activated, we look at the final observation. If all the underlyings are at or above the capital protection barrier, full capital is returned. Remember, in a growth note, for accumulated coupons to be paid out, the note must auto-call. So in this scenario, it is only the capital that would be returned. If the worst performing underlying is below the capital protection barrier, capital returned is reduced on a one-for-one basis. For example, if the worst performer is at 40% of its initial level, 40% of the capital is returned. To summarize, the glider feature is monitored daily up until the glider observation date. In this example, it was 12 months or the fourth quarter. If none of the underlyings fall below the glider barrier, then at the fourth quarter of the glider observation date, the auto-call trigger is reset lower to 60%, allowing the opportunity for the note to mature earlier. If an underlying drops below the glider barrier or trigger, the note simply behaves like a standard growth note. Importantly, capital protection mechanics remain exactly the same. Like all structured notes, while we build in features to support the results we want, ultimately, the outcome depends on the terms of each contract and how the markets behave.